Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time, and this week, guys, I have a gem for you. I have a really good lecture. It's called How to Stop Getting Shaken Out of Your Trades. Too many of you guys are getting shaken out of your trades, and then literally 5, 10, 20 minutes later, you're watching them shoot all the way up to your target. Tell me, how freaking frustrating is that, right? You're sitting there and you spend all this time scanning for an opportunity, you find a great pattern, a great entry, and then stop out. You stop out by a nickel, a dime, and then you sit there and you watch it go higher and higher and higher. No, this is not the 84% rule. This isn't just about re-entering trades that stop out. And we're going to talk more about how not to get shaken out in the first place, how not to stop out in the first place. You see, the 84% rule is only used when we make a mistake or maybe we get a little bit unlucky on something because we've done our homework and took a good trade. That is not today's lecture. Today we're going to talk about how not to stop out in the first place. All right, how to give your trades a little bit more room, how to recognize whippier stocks that need a little more room, how to just understand where the support and resistance areas are, the double tops, the double bottoms, etc. All right, so we're going to talk about how not to stop out on your trades so you can not only increase your batting average but increase your profits as well. Guys, if you like these videos, please do me a favor, click that like button, hammer that subscribe button. I'd really appreciate it. I'm Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is stop getting shaken out. Give it room. Give it room, give it room, give it room. I have quite a few examples of this. I probably could use some from yesterday and today as well. But there's just a lot of trades that you guys are in that you're always looking for the absolute, utter tightest stop that you can possibly find so that you can get to the target as quickly as possible because, well, you're just a bunch of jitterbugs, right? I mean, you're just a bunch of jitterbugs. And you know what? In a way, that's okay. Maddie, shoot me an email, jared@livetraders.com, jared@livetraders.com. So the point is I understand that thinking, that thought process. I really do, okay? I really do, because I'm that way. I'm a little bit jittery, so I will often myself look for a tighter stop loss when given the choice of a wider or a tighter one. But there are certain trades that might be acceptable, and there are a lot of other trades where that's not the way you should go about it. Well, we're going to talk about the ones that you shouldn't treat that way. I will talk about a couple that you can use tighter stop losses on, but most of them you should be giving them a little more room. And I think this comes down to not understanding your trading, not understanding what type of trade you're taking. For a quick example, a breakout is a hit and run type trade. That's a momentum trade. A 3-bar play is a momentum trade. They're not supposed to chop around, overlap, and then eventually go higher. That's not the nature of that pattern. So that's different. But if you have other types of trades, pullbacks, retest, that's more of the nature of that type of pattern. But before we do any of that, we have to talk about when will the insanity stop? This week, I think I have a good one for you guys. You know, it goes to show that insanity isn't just confined to, quote, the dumb money, right? That's what that retail traders are considered, dumb money. It can also extend itself into the smart money. And that's what we have this week, some smart money insanity. I love it. I just love it. This is actually new. As you can see it, June 22nd. This isn't from January. GameStop shares jump 9%. Investment firm closes main fund after heavy losses. Wow. Investment firm closes their main fund. Now, I want you to think about this for a second. You run a hedge fund of some kind, and you had to shut it down because of one stock? What kind of exposure did you have to that stock? Who runs your fund? Like, really? Now, I know we talked about Melvin Capital months and months ago, but this is just absurdity, stupidity, right? Yesterday, the Financial Times reported that White Square Capital, a London-based hedge fund that bet against GameStop, shuttered its main fund after suffering double-digit losses since. So not only in, but since January, okay? The retailer recently hired former Amazon executives Matt Furlong and Mike Recruiter to serve as CEO and CFO respectively. Let's just come all the way down to the bottom. All right. I'm coming down to the bottom because this shows you what these whiny little pricks, okay, little babies, sorry for the language, I suppose, but not really. All right. This is what these people do. All right. So they get their hand in the cookie jar, but they're so used to rigging the game or having the game rigged in their favor. What happens when they lose? I'm writing to seek information on how the SEC intends to address these concerns and prevent these and future incidents of potential market manipulation. That's Elizabeth Warren. Goes on to say, hedge funds such as Melvin Capital Management have bet that GameStop shares would fall in the hopes of reaping substantial... You effed up. You effed up. Own it. Girl up. Man up. Them up. Us up. You messed up. That's it. It's called capitalism. You messed up. Own it. Okay? You had 5 months to get out of this stock. You bet against it and you lost. You bet against it so bad, you didn't even have money management. You didn't have a stop loss. You didn't have any of that crap. So what's the point? Even the professionals trade like gamblers sometimes. Vegas is, I guess, is something that people just can't stay away from. All right. These are hedge funds that typically manage hundreds of millions of dollars, oftentimes billions of dollars, and they put so much stock, so to speak, in one company that it made them shut their fund. Think about it for a second, what I'm saying. Let's say you just really mucked it up on GME, like you just effed it up bad. How bad was it really if that one stock took down your entire fund? What? Your fund might have 20, 30, 40 positions, and one position took down your fund? You shouldn't have been managing a hedge fund in the first place. You stink. It's pathetic that you would go out there and ask for the SEC to step in. And granted, that's Elizabeth Warren saying that, but many, many of these hedge fund managers and big company CEOs have asked the government to step in. Why? They want it always rigged in their favor. They love it when they're getting paid out. But when they mess up, it's like the banks are too big to fail. I could sit and talk for hours about this topic, but we have other things to do today. This is just, it pisses me off when I see this kind of stuff. Own it, man. Unfortunately, in this case, a lot of normal average people lost money. That's the sad part. Okay? Now, granted, most normal people, average people, don't invest in hedge funds because most of the time you have to be an accredited investor and have at least $2 million in investable assets. So it's usually not just average people. But anyway, let's move along. Pathetic, aren't these CEOs and hedge fund managers pathetic? All right. Tight stops get stopped. Give it room, right? Tight stops get stopped. That's not always the case, but it oftentimes is the case. And you guys, it's one of the reasons we talk frequently about the 84% rule, because you get shaken out of something and then it goes and rips in your direction, okay? So again, there are no text slides today. We're just going to literally talk charts today, all right? You guys have seen this chart before. I wanted to start with one that you've seen because this is more of an obvious one that's nice. All right, but then we're going to talk more about recent trades that have been taken in the chat room and some ideas that people have taken, right? So you have a stock here that has come down quite a bit, right? From 34 all the way down to 30 to $31. Again, I know you guys have seen this before, but bear with me, okay? So red bar, 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 a lot of red bars. Wide range red bars. This is a no-brainer bounce at the bottom, right? You get a little bit of a volume spike. You get a green bar change of color here, bottoming tail, narrow body bar, and you get a bounce up. So the retest there is a bit more obvious. But, and here's the but, what happens over here, right? What happens over here? So you have this beautiful pseudo-climactic move, right? It's a $3 move. It's not insanely big, but it's a good size move. Bounces, pulls back, bounces, and what happens? You trigger in on the retest. But most traders are going to put their stop loss below the red bar, below the green bar. And maybe they give it a little wiggle room. They're probably not going to put it below that bottoming tail, which is where they should and need to be putting it. Over here, it bounces up, triggers you in, and then slop, stap, slop. I couldn't repeat that if I tried. All right, doji bar, bottoming tail. And you just stopped out because you put the stop loss right there. And then this thing rips, right? It goes from that 31.25 area all the way back to 33.50. But you're sitting there going, shoot, what the heck just happened, right? Well, you need to give them more room. And if you're not giving them more room, you got to ask yourself why. And one of the premises that you're going to hear me say frequently today is there almost always will be an area that you can add back. I say almost because sometimes there aren't areas. So for example, you get this gap up right here. So there's some profit takers right there. It pulls back. And on this day, the day after that red bar, you're probably going to get an opportunity on a 5 or a 15-minute chart to add back to this swing trade and then perhaps raise your stop up to maybe $31 or maybe under the red bar at that point. Okay? But the initial trade should be giving it more room, especially when it's a double bottom retest in a transition. Because guess what? It's not in an uptrend yet. Which means, yes, we get it. It's extended down here at 30, 31 bucks. We get it. It's retesting and it should bounce. But it might wiggle around a little, which is exactly what this stock did. And they don't get much cleaner than this. This is a very clean pullback, a very decent bounce, and a very clean retest. It still stopped you here, chopped, and then ripped. You might even get a little pseudo 3-bar play add, and then maybe you could raise your stop a little, but I wouldn't necessarily do that until it breaks this pivot right there. Okay? So when you look at that, you're saying to yourself, well, damn, I got tagged on a stock that worked. Give it more room, add back later. Remember, this is especially important in transitions. You're not in an uptrend yet. There's still a lot of sellers down here. Okay? It's different on a momentum play, 3-bar play, breakout. You're not going to give them as much room. So let's continue on. All right. Here's another example. In a downtrend, pops, drops, pops, retests, pops, retest, pops, retest, finally goes. Now this one's a little different because, well, it retests 3 or 4 times, right? And this is a smooth pullback. You can buy some here, put your stop maybe down there. And all of a sudden it bounces, retests, and now you're getting more and more confident. So this is a tough one, right? This is a tough one because you get your initial entry over here, okay? And it's not an easy entry because this stock has been in a clear downtrend, but it did finally put in a higher low, finally. Bounces up, puts in a higher high, and I would absolutely be all about buying this down here. So even if you skipped this over here to the left, I would definitely be all about buying this. Okay? So put it in there, put your stop down here. Then it moves back up, puts in an equal high, and then this happens. Well, there's not probably a lot you can do about this. So this is going to be an area where you probably have to get back in after it tags you. And it's unfortunate because now you're looking at this higher low. There's 2 higher lows here. The bottoming tail higher low and then this higher low. So now you have multiple higher lows. You also have a higher high. It broke above the moving average. So you're thinking, well, that's a pretty solid stop loss down at the green line. And you know what? It is, right? It is. But this shit happens too. It does. It happens once in a while. And if this were to happen to you, you're probably out half of your shares somewhere up in here, probably only a half stop. But you're going to have to get back in if you want to trade this higher. Okay? So this one where the circle is questionable. It's not a no-brainer here, right? Because it did break 2, 3 multiple pivot lows. This one, and this one. And then you have to really question yourself. Do I want to be in this trade? It just broke 3 pivot lows. I don't know if I would get back in it. But this does happen from time to time. Now, let's take a look at it a little differently. Okay, let's take a look at it a little differently. And yes, I'm back in plug, by the way. All right. So now we have a stock that gaps up. Okay, leaves the topping tail, leaves the bottoming tail, and rips. Just rips. And it goes red bar, red bar, red bar, lower high, lower high. Okay, you can see you're above the moving average here. So that's how it looks. Not bad, not the world's best buy setup, but not the world's worst buy setup either. By the way, guys, on plug, what did I tell you guys earlier? Do you guys remember? Did I not say almost exactly this stock will likely go down to 33.80 to 33.75 and then bounce? That's what it did. Anyway, so this would be your potential entry on plug. You don't know what the future holds. Hindsight's just so easy. A lot of you guys love to trade in hindsight, but it doesn't make you any money. Okay, so now we move over and you take the buy setup, right? This big green bar comes in, triggers you in, and maybe you put your stop loss down there and it just chops around and goes. Okay, so far, so good. Not a big deal so far. Then this happens, right? So now you get this move up and you get another pullback right here. And you're like, wow, that's an even better entry than my original entry because of how smooth the pullback is, but it's about 100% retracement, 90% retracement to the prior pivot low. Lower high, lower high, lower high, lower high. Bottoming tail at the rising moving average at a prior area of support, but in an uptrend, we don't really want these stocks to do 100% retracements, right? You are in an uptrend, higher highs, higher lows, higher highs. So you really wanted this thing to pull back to like 108.50-ish, give or take where my cursor is, okay? But it gives you the opportunity to maybe add to your position, or if you missed the first trade, get in over here. And it's not a bad entry. It's not the world's worst entry. What happens? Over here on the right-hand side, it triggers, kind of chops around, does about an 80% retracement back to the prior high. And again, I want to be clear. The reason I'm bringing these up is because we do talk a lot in PTS and in the textbook about great trades. And in the textbook, a good amount of these trades just hit and they run and they're just perfect. Well, the real world sometimes is not that way, right? And this is what a lot of buy setups look like. They pull back in a beautiful manner with a bottom. Everything about that is nice. And then it triggers and just chop, 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 chop. Really, it just chops around for the next hour and a half. And then it pulls back and tags you right there. And then it grinds higher. Okay? This is frustrating. Now, you might look at this and go, well, it never really worked, Jared. But that's not the point. It stopped you out. Okay, so when you see a stock that's this sloppy, you're going to have to give them more room. All right, nothing worse than being tagged by a couple pennies and then watching it go higher later. Okay, so give your trades more room because you will almost always have an opportunity to add back. Now, this isn't a perfect thing. There are times when you will add, and if you hadn't added, you would have still been in the trade, right? Like, what I'm getting at is nobody trades in a perfect world. No matter what you do, it will not work 100% of the time. And we've seen that. You get frustrated by it because you add to a position, which also means you raise your stop loss, and then it takes out the raised stop loss, but it doesn't take out the original. But that doesn't happen that often. So you have to look at the odds, okay? Where is the money happening? And most of the time, adding and raising your stop loss later is a good idea. Why is it a good idea? Because the more information you have, the more accurate you can be because you have more confirmation, right? More information generally means more confirmation or lack thereof, right? So now you're more knowledgeable in making that decision, okay? So this is, again, a challenging one because maybe you added some here. And if you did, you probably had to raise your stop a little bit. But this has also been a somewhat choppy trading stock. So it can be frustrating. So you have two choices. Give them more room or add back. Now you're thinking, well, geez, Jared, that sounds really great in theory. So how do you deal with this? How do you reconcile when to give it more room or not? I don't think you can. And what I mean by that is you either give them more room all of the time or you do it none of the time. You can't pick and choose your spot and say, on this buy setup, I'm going to give it extra room. Now, again, if a stock is spready or whippy, yeah, you could probably do that. But what I'm saying is go back and take a look at your trades and see which is more valuable. Serious, think about this for a second. Which is more valuable? Giving it more room so you stop out less infrequently, less often, okay? Or getting back in on the 84% rule. Because remember, to get back in on an 84% rule, you had to stop out first. So you're already coming from a minus 1R perspective. Whereas if you gave it more room, you may hit fewer targets from time to time, but you're also not stopping out minus 1R nearly as often either. And this is also another reason why I tell new traders twice to stop half the shares. It gives you more wiggle room. I'm not advocating that here today where you give you twice the stop, but give them more room. Look at a stock for what it is and say, man, this thing is a little choppy. I think I need to give it more room. And if it gives me an opportunity, I'll add back. Okay? Here's another example. And these happen on swing trades. They happen on all time frame trades. So here's a stock that was in a downtrend. Lower high, equal low, lower high, lower low, lower high, lower low. Finally puts in a higher high and a higher low. Bounces back up. And it pulls back in right here. This is what I want. It's why I blew it up. Okay? It's why I blew it up. Okay. Lower high, lower high, lower high, lower high, lower high. The world's best pullback. Not really, but an interesting pullback nonetheless on the daily chart. It triggers you in right there where it says entry on that green bar, and you're going to put your stop here or maybe here. Next day, red bar comes in, peekaboo's lower, and then this happens. My goodness, we've all had this happen to us. You just want to take your monitor and throw it across the room. You're like, you son of a bitch, you piece of shit, right? This is what you're thinking because you were right with the idea, but you got tagged. So then you got to ask yourself, where is the support? Well, there's two arguments to be made here. Bottoming tail right here is support. There's also this area in which it pulled back to the first time, which is kind of this little pseudo 3-bar play is also support. Now remember, to be clear, you're not going to know exactly how much room this stock might need. So you might say, you know what, I'm going to give it 50 cents under the bottoming tail. It might take 62 cents. So sometimes you will get stopped out. But like I said on the last slide, what happens most of the time? What is more valuable to you? Adding 20, 30% to your stop loss and not getting stopped out as often, or getting stopped out more frequently and using the 84% rate? I cannot answer that for you. Only your stats can answer that for you. All right? Say you try a blanket back test here. I'm going to add 25% to every stop. How am I going to factor that in? I'm going to take the prior pivot or the bottoming tail low, and I'm going to add 25% to it. So if it's a dollar stop, I'm going to add 25 cents. This is more appropriate with swing trading. Okay? It's more appropriate with swing trading. Okay, and then I'm going to go back test it and go, all right, I added 25% to my stops, which means targets are a little further away. What's more valuable? Getting stopped and using the 84% play, or using the 25% and getting stopped out less frequently? You will still get stopped out, obviously, right? But nobody wants to see this happen. You're in here just over $40. You have a stop loss down here at, I don't know, 37, $3 stop, $3.50, and then rip. This thing's up $10, $12 over here, and you're sitting there just twiddling your thumbs like your hands are in your face going, I can't believe this just happened to me. And now you're cursing the market maker. What can we do about it? That's the question. What can you do about it? Sometimes you can do something about it, and other times you can't. So here's another one from, I believe this was a couple days ago in Perry. Here's a stock that was up a little bit on the daily, had two consolidation days right here, gaps up. Well, one of the issues we had on Perry was this little topping tail pivot to the left, which was, I think, $21.25, something like that, right? So this thing popped up pretty strong off the open, pulls back, and gives you a pretty solid little retest. This is where we messed up because we missed that perfect first trade. Remember, this was like a 1 or a 2 minute 3-bar play. I can't remember. I think it was a 1 minute 3-bar play at 21.25 for the stop at 21. And it just barely went 2R, I think. Just barely. Pulls back, leaves a green bar. Get in over here, put your stop down there, but give it some room. Maybe put a little under the half number. And this thing rips. Oh, I don't know. You're in at, say, 2080, maybe something like that, with a stop loss under 2050, 35 cents. And this thing ends up going a good 70, 80 cents, something like that, and then chops around, and there's an opportunity to add right there. Add back at 21.55, raise your stop to 21-ish, 21.10, and chops around. Did it pay out on the ad? Not really, but you didn't know that. You wouldn't have known that at the time. Okay? So not only is this a good entry, but you should still give it some extra room on the retest because they don't all rip like this. They test, chop around, and then go. And again, sometimes they just rip. We hope and wish that for every trade, but that's not the reality of the situation. Okay? Another example. Okay? Here's a stock on a daily chart. Pulls back. Double bottom here, rips, and then just gets hammered, right? It goes from 560 all the way down to 440, bounces, pulls back, chop, 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 bounces, pulls back. You're going, what are you even looking at this for, Jared? Well, if you take a look, there's a lower high and a lower high. There's a little buy setup in here, okay? And some of you would be taking this buy setup because you're going, well, it has a higher high here and has a higher low right here. Higher high here, another higher low here, and a higher low here. Like, well, this is a transitionary buy setup. This is a stock that was clearly in a downtrend. It's a transitionary buy setup. Okay. Greatest trade ever? No, not really. All right. But this may or may not have stopped you out, right? There's a lot of junk here. This isn't the world's greatest trade. We're not trying to sell it as the world's greatest trade. Okay. But the idea that this stock was transitioning is the right idea. So whether you took that or didn't take that, that's fine. Maybe you give it a little more room because it's so sloppy. But over here to the right, now it sets up and gives you a much more reasonable entry. It puts in a new higher high, a pretty decent higher high, puts in a higher low, lower high, lower high, lower high, and 3 bottoming tails above the moving average on about a 50% retracement. So this first buy setup might have interested you. Is it the world's best? Not really. It's coming from a wide range red bar, and we talk frequently how we don't like wide range red bar buy setups. Okay, we like smooth sequential buy setups without huge bars in them. But some people probably took it, and again, if you gave it room, you'd still be in it. If you didn't, you stopped out. But over here, this is where it says stay focused. Okay, there's a decent entry at $500, and you can put your stop loss down here at $480 or $490, and this thing rips up to $570. It's a $70 move, right? So you're looking even on a wide stop at least 3.5 to 1 here. But a lot of people, again, they confuse this slop as a stock they no longer want to watch because it failed earlier. You shouldn't, right? You shouldn't. You should keep that stock on your watch list. In fact, I just did a lecture on this. Was it a couple days ago? Or I don't remember. But anyway, I did a little quick tips lesson on this. Your watch list is important. So don't give up on your watch list. Buy setups are not always going to be smooth. In fact, if you look at REGN here, what happens? It moves up, goes to the prior pivot high at 525.30, leaves a topping tail, and comes all the way back. Look at this red bar. It comes back to like 505, 502. And then rips. Most buy setups don't just trigger and rip. Give them the room they need. Give them the space they need to wiggle around, okay? Here's another example of a stock that goes from 140 all the way down to just under 40 bucks. That's a pretty serious drop, right? 140 all the way down to just under 40, right? This was during the pandemic, okay? When a lot of people thought, hey, Vegas may never come back. Bounced back up, pulls back, puts in a higher low. This is fine. There's nothing wrong with buying this right here, even though it is pretty sloppy. The big time volume came in, and then it puts in a higher low. So now here's the rub, okay? And this is what I wanted to focus on in this slide. What's the first inclination? Buy it on this green bar right here, okay? And put your stop under the red bar. Tell me I'm lying. That's what almost every one of you is going to do. You're going to buy it on the green bar and you put your stop below the red bar. That's okay. I mean, it worked, obviously, right? But what is or what are one of the choppiest patterns that we can trade? Climactics, parabolics. Because of the nature of the pullback, they frequently take 2 or more entries. This is right out of the textbook. They frequently take 2 or more entries, okay? Well, here's an opportunity where, yes, you're giving up a lot. If you got in here at, I don't know, $52, I mean, my goodness, your stop loss is insane. So what can we do here? Well, you have kind of three choices. You can use right under the red bar's low, knowing that you might get tagged, okay, because they do chop around. You can use where the green line is, knowing it's the safest area, and you can likely add back. Or you can kind of use a 50% area, right? You can get in at like, I don't know what that is, $52, and maybe put your stop $2 or $3 under the red bar. See, the problem is right now you are all looking at the hindsight. You're all looking at this going, but it worked. Why the hell would I give this more room? But then when you have a look at AVIR today, right? Take a look at AVIR today. Bet you wish you gave that more room, huh? Because it went down to the low of the day, tagged you by 20 cents, and now it's back up, isn't it? It's back up. Same concept. So you happen to be looking at the one that just hit and ran. But it also gives you an opportunity to add back, right? You can add back at the $80 area, raise your stop up to 65 or 70, chops around, and eventually goes. So some of you are going, oh, this is just dumb, Jared. Of course I'm going to use the red bar and take my chances. I'm telling you, on parabolics, there's at least a 50-50 chance you're going to get shaken out on the tight stop. Probably more, and then it's going to go. This is why we talk frequently about using two entries. So then you have to go back to my original comment and ask yourself, is it better for me to use the tight stop and get shaken out more frequently and use the 84% to get back in? Or is it better for me to give it all the room, make less money, but stop out less frequently? Think about what I just said. Let's play it both ways. Let's just say you got in here at like 52 and your stop loss is like 45, okay? $7. And this thing moves on up and then say it stops you out. And you had to get back in, all right? And you got back in with the same entry and same stop. So you lost an R, you get back in, and this thing goes up, and maybe you sell it at the moving average at $80, right? That's a $28 gain. That's a 4R gain, but you gave up one. Okay, you made 3. Whereas if you got in here, and let's say you gave it $40 as a stop loss, gave it extra room. Now you have a $12 stop loss. And let's say you still got out at 80. Well, it's still a $28 gain. You made 2.5 R's. So in this case, it would have been a little bit better to use the 84% rule. But what's more important, or what makes you more money big picture, long run? That's what you have to find out for your trading. Okay? All right. Multiple time frames. Guys, I got to end this in about 5 minutes, and we have 2 or 3 more slides to go. All right? Multiple time frames. This stock gaps up, breaks the prior pivot high, pulls back to an area of support. Okay? Bottoming tail. Now, here's the rub. Beautiful, nice 10-minute buy setup. Nice 10s. There we go. How about that? Nice 10-minute buy setup. And you're thinking to yourself, lower high, bottoming tail, green bar at support. Yeah. But if you were on the 1 minute, you stopped out if you didn't give it room, right? This is a 1 minute retest buy setup, big old bottoming tail. It triggers you in on that little tiny topping tail and then stops you out by 10, 15 cents and then goes higher for the rest of the day. What's the lesson here? 1, give it more room. Retest often and frequently, same word, I guess, chop around and then they go. Give it more room. But the other thing you want to learn is, well, what's happening on other time frames? So you're thinking, well, what are you getting at, Jared? What's the point here? Maybe nibble a partial on the 1 minute retest. Give it all the room, 33, knowing you will likely get an area to add back. Comes down to the low, comes back up, then it triggers the 10-minute buy setup. Over here is where it triggers it. You can see it right there. It triggers it right there. Now, you can raise your stop up. See where I'm going with this? So take the 1 minute double bottom retest. Give it all the room. And I know you're going to be tempted not to. Jared, I'm not taking that damn thing with a 75 cent. You're on crack, man. Well, then you stopped out. I'm not on crack anymore, am I? You stopped out. Then you had the opportunity to get full on the 10-minute buy setup. Does this guarantee a 10-minute buy setup will happen? No, it doesn't. But you know what it also does? it makes sure that even if Riot continues lower, you have a lot of protection down here. And if it stops out, you probably didn't want to be in it anyway, and it was a good stop. But you don't want to be peekabooed on this thing. There's nothing worse than being peekabooed and watching them go back up. So this is where you can use multiple time frames, give it more room, and then say, you know what? I'll take a half lot. I'll take a third lot because of this type of retracement. It's not 100%, it's 110% retracement, but I do like that it broke the prior pivot high. I do like that it's sitting on support. Maybe it's showing relative strength, all of those things. And then the 10-minute confirms your entry. All right, same here. You guys have seen this before. Downtrend, bounces, retest, aggressive entry down at the bottom. Go light, go half lot, go light. Give it room, all kinds of room, because you're probably going to get an entry somewhere else, an area to add back. Bounces back up, wide range bar comes in, takes out all the resistance, gives you a little wedge pattern, boom, add here, raise your stop, and now you're making money all the way back up. In this particular case, it didn't need the wide stop loss because it worked, but that doesn't mean next time it won't use it. All right, give it room, look to add back. Give it room, look to add back. Give it room, look to add back. Okay? Now, every once in a while, you're going to have ones that you shouldn't have taken anyway. And that's why I put this one in. And why did I put this one in on Nike? Because this is not a gap that you're likely going to trade. This thing had a huge gap up, followed by a red bar, and then it took off the next day. Some of you out there going, ooh, look at that 3-bar play. It's not a 3-bar play. And you can see from today's result that, well, it's pulling back. There's profit taking up here. Okay? So when you look at Nike and you see this over here, one, this is not a wedge I would have taken at 153.50. There's no way. And then this is not a buy setup I would have taken at 153.25, even though it worked. And this is the problem with new traders. You're going to take a situation like Nike and you're going to justify, after the hindsight bias, next time you see this situation, you will justify taking that crappy pattern. You will. Some of you may have even taken it. You will. Don't take it. This is what I mean by when the markets, the NASDAQ 100 went from 50 to 350 in the last 9 years. All you're used to is shit going up, right? So extended stock goes higher. Extended stock goes higher. This is a ridiculously big gap on a stock that only had one resting day. I mean, the stock went from 127 to 150 something. One resting day is not enough, and you can see that by today. There's a good chance Nike's going to chop around for a while. A really good chance Nike chops around for a while. Okay? So again, no way I take it at 153.50, and definitely no way you take this. Why? Because the inclination here is this stock should go lower. It didn't. All right. That's why we have stop losses. We're not always going to be right. But I would not have taken this, period. It's just not a long play. Okay? It's just not a long play. All right, so I got to run, guys. I'd like to stick around a little longer. Quick comment. Just think about this for a second. I'm not gifted. I'm just driven. There's a lot of people on this planet. I'm going to spend 1 minute on this. There are a lot of people on this planet that really aren't the most talented people in the world. They're really not. But they work their ass off. And they overcome. What's the point? You don't have to be Einstein. You don't have to have the talent of Tiger Woods. You don't have to be that person to be exceptional. Maybe to be the best ever, you might need both. But to be exceptional, you don't need to be gifted. You just need to be driven. Believe it. I'm serious. Believe it. Work harder than somebody else. Outwork your neighbor, and you'll out-succeed your neighbor. Okay? That's a fact. The problem is most people aren't driven enough. Why? Because at the first punch in the mouth, they fall to the ground and don't get back up. I'll repeat it. In the first punch in the face, they fall to the ground, but they don't get back up. I'm here to tell you, everybody gets punched in the mouth. Everybody's knees buckle. Everybody hits the canvas once in a while. But what do you do about it? Everybody goes through a losing streak in trading. Everybody has a tough month in trading. Everybody has a tough day or week in life in general. You don't wake up every day and it's like, my goodness, life is just the best today. Some days, a lot of days, not every day. So how are you going to overcome? Be more driven than the next person. You don't have to be more gifted. Persistence truly does overcome resistance. Most of you just don't want it bad enough. It's that simple. All right. With that, guys, I do apologize that I have to run early, but I hope you guys enjoyed this week's lecture on giving stocks a little more room so you get stopped out less frequently. I'm Jared Wesley of Live Traders. We'll get back at it again next week.